Hey, this is Jim Hiles, and I'm your financial coach. So let's talk about a really exciting topic, the yield curve. So what is the yield curve? So simply, the yield curve it looks like a curve most of the time. So what you do is you take a piece of paper and you have an axis up and down, and let's call that interest rates. Okay. Then on the bottom axis here, the XY axis, you're going to put time, interest rates, and time. So what happens is if I want to lend money or borrow money and I want to borrow that money for 10 years, there's a cost to borrow. Well, the market will tell you what the cost to borrow is for that 10-year. And let's just say it's 3%. Put a number on it. Boom. And then you say, well, what's the cost to borrow money for 5 years? Put another number on it. And you go all the way up and down the terms, all these terms, starting from literally overnight money to something go out there 30, 40, even 50 years. And what happens is, it actually, if you connect all those dots, it does create a little curve. The traditional, properly functioning market action is literally looking like a curve, and it kind of curves lower to upper. Why? The lower end of it is generally considered short-term money, which means, assuming you're lending money to somebody and that person has pretty good credit quality and can pay you back, if I lend that person that money for a year, then I really am only at risk as a lender, giving somebody else the use of that money for a year. And I'm going to get paid for whatever that rate is. Now, you would think if I'm only lending it out there for a year, the rate should be less than lending it out for, say, 30 years. And that is traditionally how it works. Longer term loans are obviously, you have to wait longer to get your money back, all your principal back. So typically it costs more in interest rates if I'm willing to lend money as a banker for 30 years. I want to get paid something a little bit more than what I can earn on my short-term money. So typically speaking, the yield curve says the longer the loan you're borrowing on or lending to somebody else to use, the higher interest rate you should expect because your money's out there for a longer period of time. This kind of makes some sense, doesn't it? Hello? So that is a traditional yield curve. Short-term money, long-term money, rates generally curve upward over the length of time. So now that you kind of got this concept, you might want to start applying what you're seeing on the screen here a little bit, and that is trying to understand why interest rates are important and what signals they may trigger to the economy. And you hear this term, inverted yield curve. Well, that means instead of the short-term money being cheaper, shorter term, long-term money being more expensive, they kind of reverse. And that can create some problems, or maybe it means something, which what most economists would say is that most recessions there's been an interest rate, a yield inversion prior to them. Not all, but most. And that could trigger a red flag. If you're nervous about that, perhaps we should be. But typically that inversion, short-term rates being inverted with long-term rates, it takes like a quarter of sticking around before it gets really serious. And generally, the recession isn't going to happen the next day. It takes some period of time. It's not necessarily imminent. It could take anywhere from 6 to 9 to as many as 20 or 24 months before a recession comes. So a little bit about the yield curve, a little bit about what inversion may mean. Hopefully this is helpful. Make some sense of this. Again, Jim Hiles. You can subscribe to our YouTube video. You can send me an email, text. I still pick up the phone once in a while. You can always give me one of those old-fashioned jingles if you want. Anyway, signing off for now. Talk to you soon. Thanks.